Index funds are mainstream. At year-end 2021, more of the US stock market was owned by index funds than by actively managed funds. Funds only own about 30% of the US market in total, but taking a broader view of institutional investors, assets have been shifting toward passive institutions. Index investing as a theoretically optimal investment strategy works best in an efficient market. But if everyone turns into a passive index investor, the market can't be efficient. This is commonly known as the Grossman-Stiglitz Paradox, and it has some people raising the alarm about a tipping point for market efficiency. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you what the continued growth in index funds' popularity means for market efficiency. In an efficient market, the market portfolio, which we can proxy with stock and bond index funds, is the optimal portfolio for the average investor. This makes investing easy and low cost since index funds are accessible and cheap to own. Investors today can passively own the total stock and bond markets with one or two index ETFs. If, on the other hand, markets are inefficient or become inefficient, the market portfolio is no longer optimal and investors should, at least in theory, switch to being different from the market, known as active management. This is documented in On the Size of the Active Management Industry by Pastor and Stamba, who argue that the active management industry faces decreasing returns to scale. The ability of fund managers to outperform a passive benchmark declines as the active management industry's size increases. As more money chases opportunities to outperform the index, prices are impacted and the opportunities become elusive. In this model, negative alpha for the active management industry as a whole is a sign that too much capital has been allocated to active management, not that active managers are unskilled. The corollary is that if the active management industry gets too small, there will be alpha opportunities for investors, and capital should shift from passive index funds to actively managed funds. This introduces some uncomfortable uncertainty for index investors. How do you know when this tipping point has been reached? Are we already there? If you switch to active, when do you switch back to passive? Having to answer these questions affects the simplicity and hands-off nature of index investing, which are some of its biggest appeals. Fortunately, I have some good news. We're nowhere near the index investing tipping point, if there is a tipping point at all. Most people telling you otherwise are probably trying to sell you something. Hopefully that feeds your index investing confirmation bias, but I do want to make sure that you understand why I hold these beliefs so you can filter out all of the noise telling you otherwise. A 2007 theoretical paper from Fama and French, Disagreement, Tastes, and Asset Prices, shows that if misinformed and uninformed active investors who make prices less efficient switch to market cap indexing, market efficiency improves. If informed active investors turn to indexing, prices become less efficient. But as long as there are some remaining informed investors competing to bring information into prices, the market remains efficient. This raises an important question. Who is switching to indexing? If it's mostly uninformed or misinformed active managers switching to indexing, the capacity for indexing to grow without making markets inefficient is nearly infinite. In a 2015 paper measuring skill in the mutual fund industry, Burke and Van Binsbergen find empirically that there is evidence of persistently skilled mutual fund managers, and that fund investors are proficient at rewarding skilled managers with flows into their funds. Most active funds in their sample destroy value, but most of the capital is controlled by the skilled managers. This seems to help answer the question of who turns passive. The relatively few skilled managers end up with capital flowing to them, decreasing their alphas for investors, but increasing their fee income and keeping markets efficient. Data for institutional investors, as opposed to just mutual funds, tells a slightly different story. In Which Equity Investors Matter for Equity Valuations and Expected Returns, Coyen, Richmond, and Yogo find in a sample of institutional investors that overall active share, or how different institutions are from the market, has declined over the last 40 years, mostly due to capital moving from more active institutions to more passive ones. They use a sample that spans not just mutual funds, but investment advisors, hedge funds, pension funds, life insurance companies, private banking, and brokers. They find that the aggregate active share, or how different institutional investors are from the market, dropped from 45% in the early 1980s to a little over 25% at the end of their sample in 2019. This demonstrates that the shift toward passive is not exclusive to funds, which make up only about 30% of the ownership of the US stock market. Importantly, they find that the capital going passive was leaving both informed and uninformed active institutions, leaving price efficiency relatively unaffected. To test how this shift may have affected asset prices, they model the counterfactual where the shift never happened. They find that the move from active to passive has resulted in a substantial change in valuations, especially among smaller firms. While they see this valuation effect mostly in small firms, they find that the informativeness of prices is affected very little. I think it's interesting to note that this is the opposite of the index fund bubble narrative, which suggests that assets flowing into index funds are pushing prices up beyond their fundamental values. They also find that the most impactful groups of investors per dollar of assets are hedge funds and small active investment advisors. On the other hand, a huge, mostly passive firm like Vanguard, as an example, is not influential at all in setting the cross-section of prices due to the fact that they simply own the market. When a dollar is added to a market cap weighted Vanguard fund, the flow proportionally affects all stocks in the market, and there is no cross-sectional price impact. This is, again, contrary to the common narrative that index funds are causing the prices of certain stocks to be inflated. This doesn't mean that the growth in indexing has no effect on markets. Index funds may decrease the elasticity of the market. An inelastic market is not necessarily less efficient, but it is more sensitive to flows. But it's also not clear that the growth of index funds has made markets more inelastic. To make that claim, we would need to know in aggregate where the assets that flowed into passive funds came from. If it came from individual households who had been buying and holding individual stocks, passive index funds, which are periodically reconstituted, may actually make markets more elastic. To finish on Coyen, Richmond, and Yogo, the shift toward passive has likely affected valuations, particularly among smaller firms, but it has not affected the efficiency of market pricing. It is possible, but not guaranteed, that the rise of index funds is making the market less elastic, but this is not something that impacts the way that individuals or institutions should manage their portfolio allocations. Finally, taking a look through the lens of the Grossman-Stiglitz Paradox framework, Coles, Heath, and Ringenberg find in their paper on index investing that passive investing does not undermine price efficiency. The casual narrative is that if index investors are free riding off the information production of active managers, more index investors should lead to less information in prices. However, the authors of this paper predict that the rise of index investing will have no effect on price efficiency. Their intuition is that in equilibrium, a decrease in the total cost of index investing leads to more index investors and less active investors. But because investors always choose to gather information when it is profitable to do so, the proportion of investors willing to pay an additional cost to uncover new information adjusts such that the returns to active investing remain unchanged, even as index investing increases. As a result, price efficiency remains unchanged. To empirically test the predictions of their model, they examined the effects of index investing on information production and price efficiency using variation in Russell Index membership as an exogenous shock to stock ownership by index funds. In their sample, they find that shocks to the mix of passive and active investors cause significant changes in trading behavior and information production, but these shocks do not alter the information content of prices. These results suggest that index investing does have effects on investment and information production, but as theory would predict, the fraction and effort of informed investors adjusts so that the relation between price and fundamental value is unchanged. In other words, the rise of index investing does not significantly affect market efficiency. The tipping point for passive index investing largely depends on the level of competition among the remaining active investors. If informed active investors turn passive, the market gets less efficient and investors should switch to active. On the other hand, if only the misinformed active investors turn passive, the market gets more efficient and investors should index. Some evidence suggests that capital does flow to informed managers, rewarding them with scale. Other evidence suggests that both informed and uninformed managers have been giving up capital to passive investing, leaving the overall level of price efficiency unaffected. In either case, and in line with the Grossman-Stiglitz Paradox thinking, as assets shift into indexing, the remaining active managers will choose to gather information when it is profitable to do so, and the proportion of investors willing to pay an additional cost to uncover new information adjusts such that the returns to active investing remain unchanged, even as index investing increases, leaving price efficiency and the effectiveness of index investing as a strategy unchanged. Thanks for watching. Since we've discussed this topic and many of the papers I referenced in this video on the Rational Reminder podcast with the paper's authors, we've made a short compilation of the relevant clips from those conversations and posted it on the Rational Reminder YouTube channel. These clips include conversations with Luboš Pastor, Jean Fama, Jonathan Burke and Jules Van Binsbergen, and Ralph Koyen. My hope is that this compilation reinforces my message in this video and exposes you to some of the incredible conversations that we've had on the Rational Reminder podcast.
Then there's nobody there to, trade to make the market efficient. So the people who actually have information that other people don't have, you want them to stay in the market and use that information. So the real question that nobody's ever answered is, how many of those people are there out there? How many does it take to make the market efficient?
I hope you'll check it out and subscribe to that channel where we post a new episode every week. Thanks again. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who you think could benefit from the information.